Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, October 6th, 2020. We're looking at a bit of a pullback today after yesterday's stunning rally. The rally yesterday certainly was predicated on the idea that the president is getting back to normal. I think as a nation, we don't want to see a sick president. We don't want to see a president in the hospital. I don't think that's good for anybody, and I think that that's what the markets reacted to yesterday. Part of it is also you're sort of near the beginning of a new month. New months tend to get a little, you tend to get a little bounce. We had a bad September. All this stuff is out there. What we did see yesterday was VIX rise as the market rose, and I alluded to that in the note I put out. And I can go into I think you should read that because I can get into much more detail in a written note than I can in a verbal one. But suffice to say that VIX is a 30-day look ahead at the market's expectations of volatility. Election day, as of yesterday, was 29 days. Today it's 4 weeks. That's within the 30-day period. So the bump that you saw in October is somewhat migrating into spot VIX because that's actually in some ways a better indicator of the period that encompasses election day than the October VIX future, which is sort of mid-October on out. Theoretically, that's looking into mid-November. As the race appears to get more lopsided toward Joe Biden, we actually take some of the election chaos idea off the table, I think, which is why you'd start to see it move towards spot because this period incorporates earnings season. Don't forget about that. It does come later this month. Starts probably a little. The problem for the October VIX future is that earnings season starts shortly after it expires. So again, it's looking that future is looking beyond it. The current VIX spot VIX is looking incorporates that period. Let me more explicitly. Let me put it that way. So these are concepts that you should be thinking about when you see the markets doing what they're doing in terms of volatility. Right now we're seeing growth versus value sort of tighten the spread, growth outperforming a bit. A lot of that is coming from the banks. Banks like it when yield curves steepen. That said, we are far from a steep yield curve. We're talking about, depending on how you look at it, 50 basis points of steepness, 75 basis points of steepness. That's not a steep yield curve, but I think the banks are so beaten down that any piece of good news to their funding environment would be helpful. Also, we're seeing some negative stories come out on the mega cap growth stocks. Rumblings out of Congress for ways to sort of shrink their footprint somewhat, and that's one of those things that ultimately is not good for them. And so you're seeing a bit of the closing of the growth value spread. Remember, spreads close for a few different reasons. The underperformer can simply outperform the outperformer for a while, capturing that difference. Of course, the simplest way to think about it is the underperformer goes up and the outperformer goes down. They can both go down, just the outperformer goes down faster. So we'll see how that all works. I do think that there is some logic to this trade, especially when you think in terms of the tax consequences of a Biden victory. I do think you will have people trying to front run the potential for a capital gains tax rise. There are a lot more capital gains taxes to be taken in the mega caps than there are in the growth stocks, and that could provide what I would call some marginal underperformance, so marginal selling in that regard. Another thing to think about is from the January effect, which you've heard of, is sort of when underperforming stocks outperform in January. The logic behind that is people tend to sell their losers in November and December because you want to establish a tax loss, and then you kind of buy them. You have to, in the U.S. tax code, you have to wait 30 days before you buy it back, and so people tend to sell it out in November, December, and start to look to buy it back in January. You may have an interesting problem here in that you may be incentivized to have tax gain selling and tax loss selling. Remember, if you're looking at a capital gains tax that's going to go up by double digits, that takes a double-digit bull market to make up for the difference in your taxes, because all of a sudden you're looking at an after-tax gain uh, that is impaired by a higher tax rate than it would have been otherwise. Now, a lot of stocks are held by non-profits, pension funds, endowments, etc., but trades and movement occurs at the margin. And I'm not saying that everybody's going to kick out their stocks just to save a few bucks on capital gains. It's actually nonsensical for certain types of institutions to do that. But I do think taxable investors will be starting to think in those terms. Let's talk again tomorrow. Take care. Bye-bye.